Hey everyone, and welcome back to the channel. We've got some major breaking news coming out of the financial world today that's already sending ripples through the crypto and tech sectors. The US Federal Reserve just wrapped up its highly anticipated January 2026 meeting, and while they decided to keep interest rates steady for now, the real story is in the details. So, what happened? Chairman Jerome Powell took the stage, and honestly, his tone said it all. The market was hanging on every word. While the decision to hold rates wasn't a huge surprise, Powell made it crystal clear that the fight against inflation is far from over. He emphasized that the Fed's future moves will be strictly data-dependent. This isn't a preset course, they're going to react to the economic numbers as they come in. For us in the market, this means one thing: uncertainty. Now let's break down the immediate market reaction. Bitcoin, as usual, was the first to react with some pretty wild swings. We saw a sharp dip followed by a partial recovery as traders tried to figure out what this data-dependent stance really means for liquidity. Is the risk on appetite back, or is this just a temporary pause before more tightening? Gold also saw a significant move, pushing up against key resistance levels. This is a classic flight to safety indicator. When investors get nervous about the economy and potential inflation, they often turn to gold as a store of value. And what about the US dollar? It's been bouncing around, trying to find a clear direction. A stronger dollar is typically bad for assets like Bitcoin and stocks, so all eyes are on the DXY index right now. This brings me to a really important point, especially for anyone actively trading. The volatility around these Fed meetings is no joke. We saw it happen today. Algorithmic trading bots and institutional players move massive amounts of money in seconds based on specific keywords in Powell's speech. If you're trading with high leverage or based on emotion, you can get wiped out in the blink of an eye. This is a time for caution, not for making impulsive baits. Always have a plan, set your stop losses, and don't risk more than you're willing to lose. The market is a battlefield during these events. So, what's the big picture for 2026? The Fed meeting didn't give us any new specific regulations or policies for digital assets, but the underlying message is impossible to ignore. The three biggest factors that will shape the crypto and tech markets this year are liquidity, inflation, and regulation. The era of easy money is on hold, and the Fed is watching inflation like a hawk. Any signs that it's heating up again could trigger a faster-than-expected rate hike, which would pull liquidity out of the markets. This environment demands a strategic, long-term approach, not just short-term gambling. So, how can you navigate this? First, stay informed. Don't just watch the price charts, understand the macroeconomic forces driving them. Second, focus on projects with real-world utility and strong fundamentals. In a market where capital is more selective, hype alone won't be enough to sustain growth. We're talking about projects with actual use cases, revenue streams, and solid development teams. Those are the ones likely to weather the storm. And finally, consider diversifying your portfolio. Having a mix of assets, maybe even including traditional ones like gold or equities, can help balance your risk in these uncertain times. The key takeaway from today is that the game has changed. We're in a more mature, more complex market environment. The Fed is in control, and its decisions will continue to have a huge impact on everything from Bitcoin to your favorite tech stocks. It's more important than ever to be educated, strategic, and patient. Thanks for tuning in today. If you found this breakdown helpful, make sure to hit that like button and subscribe for more deep dives into the digital economy. Let me know your thoughts on the Fed's decision in the comments below. Stay safe and stay strategic. I'll see you in the next one.